Hey, Courtney Smith here. I want to tell you what's really going on in these markets right now because we've come down extremely hard this week and it really changes my idea about the market. So we'll get into that later, but first, what happened? There's really two factors that caused the market to sell off. The big headlines are all about potential trade war after President Trump initiated tariffs on steel and aluminum. However, I'm not really seeing that as a big deal. First of all, he exempted 85% of our importers. So he exempted Canada, Mexico, the European Union. So really, it was a tariff on Chinese steel. We don't import that much Chinese steel. The second thing is that then we got retaliation from China and threats of retaliation from Europe. As I speak, there's been no retaliation from Europe. And what they've really done is target specific industries of about I think it's actually $11 billion worth of trade, which is something, but not a big deal. Specifically, of course, the one I like the best is they targeted Harley Davidson, which are produced in the district of the Speaker of the House, Paul Ryan. I'm sure it's just a coincidence that they picked on Harley Davidson, but that's the truth of the matter. China, however, did retaliate, and that once again led to ideas of a trade war. But the reality is that they only retaliated on $3 billion worth of trade. I say only, but in the trade world, that's not a big deal. Most importantly, they did not target soybeans. Soybean exports to China last year were $14 billion. That's really our biggest export there, other than things like intellectual property, like movies and things like that. So I don't really think that the trade war issue is a big one. Trade wars are terrible for the economy. We do not want a trade war by any means, but so far we're using toy guns and air guns. We're not using even pistols yet in this so-called trade war. Every president since World War II has put tariffs on. Harry Truman was famous for it. JFK was famous for it. We saw Obama put tariffs on, retaliatory tariffs on tires. So every president does it, and it doesn't lead to a trade war. So let's not get hysterical about it. Let me tell you what really happened. What really happened is interest rates were raised by the Fed. Even that was not important. What happened really was the tone and the words that new Fed head Jerome Powell used to describe what's going on and why they raised and what they're going to be doing. That was the critical component. You see, what happened was the raise of 25 basis points was totally expected, so there was no news there at all. But what he said was that the economy is getting very strong. And they basically said, we're going to raise interest rates, 2-3 times more this year. We're going to probably do 3 times next year. We might even do 4 times here in 2018. So when you add that all together, if you say 4 times, well, that means that the Fed funds will go from 175 to 275. If you add 3 more 25 basis point moves next year, that'll be up to 350. That increase in interest rates hits all capital goods in a society, and the stock market is one of the most important capital goods in a society. So what's happening is that we're discounting future earnings of the stock market at a higher discount rate, which means they're worth less. And that is actually, I know it's a little academic, but that's actually why the market sold off, is expectation of more interest rate hikes than was anticipated. So right now, I think that the market still has a bit more discounting on the downside before we start to resume a bull market. The other thing, well, you know what? Let's do this. Let's go through and talk about probably the most important thing, and that is, of course, the disclaimer. All right, everybody, welcome to Wall Street Winners. We're so excited to have you here. Don't want that. I want this one. Here's the S&P 500. You can see it fell down very, very rapidly, but the purple predictor remains strong. Let's take a look at the Dow. Look at in the upper right-hand corner where I put that red arrow, and what you see is that selling pressure, the red line, accelerated significantly. We also saw buying pressure reduce, not a lot, but it did reduce a little bit. Here's another key thing on this chart. You see the black line in the upper right-hand corner? That's the ADX. And it's been going down now since the peak of the market at the end of January. Well, when the ADX goes up, that's a confirmation of a trend. That's a confirmation that we're in a new bear trend. When the ADX was going down, it was saying we're in a neutral market. We're going sideways. But when the ADX starts to go up, that's a trend indicator. And it says this is a legitimate bear market. Now, let's take a look at the Nasdaq. Also down hard, also purple predictor, not that bad. Seasonality. I've got on here bullish. Well, you know what? That's pretty amazing. I said it has to break through that 148 in order to be bearish, but you can see we can break through that very, very quickly. Also, notice that the purple predictor is holding up. In other words, we're seeing some smart money take advantage of these dips in the market to be buyers. Seasonality here. Now, this is a really critical component. Here we are towards the end of March. And if you look at third week in March, you see that there's an expected dip in the market. Now, it's just about a 0.5% dip, and we've dipped much more than that. And then we're supposed to rally to seasonal highs in the third week of April. And then we start a long 6% decline into the lows in early fall. We've dropped a fair amount here right now. So it's quite possible, we don't have our official indicator suggesting this yet, but it's quite possible that we've already reached our seasonal peak and that we've started what should be a seasonal decline. Now, normally we would expect the seasonal decline to be maybe choppy, but pretty well behaved, not a plunge-o-rama, but a boring-o-rama, okay? So instead, we've got a plunge-o-rama. This seasonal suggests that we'll probably get some rallies in here, but still remain under pressure as we go through the late spring and through the summer. The yield curve's not going to help us out as well. I told you this is going to keep a cap on profits. Well, obviously that's happened. Now, this was an important chart. Asset allocation has been grinding higher, but as you can see here, late in the week, it completely evaporated. And for the first time, I shouldn't say the first time, but we've just seen a massive change in what's going on in the market. Let me give you an insight you will not hear any place else, which is why you have to watch this video every single week. What we're seeing is this. We're seeing money now go out of the stock market, and it's going into the bond market as a flight to quality, as a safe haven. That's where it's going. At the same time, we're seeing some smart money come in and do a little buying of these stocks. So new money is coming in from the smart money, but most of the money, retail money, is flowing out and it's going into bonds as a safe haven. People are very, very nervous, very anxious right now. Another interesting indicator was the stock market risk indicator held up very well. So in other words, the flight to quality was not into defensive sectors, really, like consumer staples. Instead, it went into bonds. Okay, you see, tracking the money flows and where money is going is very important for understanding what's going on in the market. Global shares, who cares? They're down. Bonds, all right. So bonds is where the action is. Now, the interesting thing to me is, with massive amounts of money going into the bond market, it's really just grinding higher. It's just grinding higher. I mean, this could be a big bearish flag formation. That could happen. Could be. So it makes me nervous. But I want to get long some bonds in here. I can use it as a hedge against a further decline in the market. This is very important. Why? Because the old saying is that the bears take the elevator and the bulls take the stairs. And what that means is bear markets are short-lived, but they are sharp. They go down fast and hard. And so because they don't give you a lot of time to react, we have to react quickly, whereas bull markets can go on for years and years and years. Bear markets usually go on for just a few months. We don't know if this is a bear market yet. That requires a 20% decline, but we're certainly in a bear mode by any means. So I want to get long some bonds. Bond key factors. Let's take a look at them. The yield is the green line. You can see that gold rallied up this week. We'll get to gold in a second. Very important change in attitude there as well. But the 10-year treasuries in Germany, the blue line, plunged down. Yields plunged. So that is the most important factor because the U.S. bonds compete with with the blue line. That's the most important one. The actual chart, the CRB, not a big deal. The dollar, under pressure. Gold. Now, this is where I really want to get into. Let me go back to dollar. If the dollar's under pressure, then we should see gold go up. And that's exactly what we're seeing. But what we're seeing is a sharp up move. Even though gold is dribbling lower, we're seeing gold start to perform very, very well. Now, if you remember, for months now, I've said, if the dollar is so weak, why isn't gold rallying stronger? You see, it's not the news that's important. What's important is the reaction to the news. And what we saw was no reaction to the news in the gold market, to the news that the U.S. dollar was going down. All of a sudden, dollar's going down just a little bit, but gold is exploding to the upside. So, fully paid up members, I'm getting long gold stocks now, okay? Wait till we get to the fully paid up member section. For you freebies, come on, get your act together and sign up and become a fully paid up member so you can see the specific stock that I'm going to recommend. Now, our indicators are roughly neutral, but you can see down at the bottom, the yen exploded to the upside, and that's what really dragged up the price of gold. Oil. Another big change in my attitude. I'm becoming more and more bullish on oil. I started becoming more bullish recently. I'm getting much more bullish. We are seeing an increase in supply of oil, which normally would be bearish, of course, but we're actually seeing a larger increase in demand than we are for an increase in the supply. So the supply-demand fundamentals, because the accelerating economy on a global basis is helping the oil market out. So, once again, fully paid up members, wait till you see the trade that I've got for you. All right, Bitcoin, dribbling lower. You know in my special report that I did that I'm not a big fan of Bitcoin. What I said in that, which was a dramatic call that nobody else called, is I said I thought that it would get to about $5,000. Maybe down as low as $4,500. You can see that back in January, we got to, let's call it 6,000. It was just under 6,000. I think we're probably dribbling lower now. This is not going to get the explosive price movements that we've seen in the past for the simple reason that now people can sell short Bitcoin very easily on the futures market. Now we have a two-sided market. So Bitcoin has to go back to some type of value. And my analysis is that the value in Bitcoin is around $5,000. Now, how did I come up with that since it's just a fiat currency? It costs about $5,000 to mine a Bitcoin right now. So what happens is that any commodity, and let's call Bitcoin a commodity, always trades down to its cost of production, and usually a little bit lower. Then so think about this. If it costs $5,000 to mine a Bitcoin, and the price goes to $4,000, then there's no incentive to mine Bitcoins. And as a result, the production of Bitcoins will shrink, thus shrinking the supply, and assuming the demand stays the same, we'll start to see a bull market again. So we need to go through that phase of the destruction of the supply of Bitcoins in order to get into a realistic, long-lived bull market. Not the speculative blow-off that we had before. Remember, Bitcoin is trading tuna. It's not eating tuna, okay? Very important. All right, that's it for me, freebies. Listen, you have to keep coming back here because there's so much happening in the market today. Wall Street Winners is the video newsletter. It's your video briefing that you need to look at. All right, we'll see you next week. Fully paid up members, hang on, got tons more to show you.